Okay, we'll give everybody a minute to log in. We have the recording on and we will get started. Hello, everyone. Thank you for those of you who were able to take the time today to watch our informational presentation. We will get started in just a minute. I want to give everybody an opportunity to get settled. About 30 more seconds. I'm seeing some familiar names and faces. Hello, for those of you returning. For those of you who have not joined us before, welcome, welcome. Okay, let's go ahead and get started. Hello, everyone. My name is Jess. I am with ERPfixers, and welcome to our April Ask a Fixer webcast. Today, we will be discussing analytics-based enterprise performance management, a mini MBA in 60 minutes. Presenting with us today is Gary Cokins and Carlos Polito. Before we dive into the actual presentation, I want to go over some housekeeping rules. We will not have time for the Q&A at the end of the presentation. This will take the full 60 minutes. So for those of you who have questions, please submit it in the chat box or the Q&A box. You can find both of these at the bottom of your screen. And I will be collecting these questions throughout the presentation. I will send them to Gary and Carlos, and we will post these on the ERPfixers website, as well as our YouTube, and send out an email for those of you who registered. You can also contact Gary and Carlos if any additional questions arrive, and they'll get back to you as soon as they can. Next slide, please. What is ERPfixers? We consist of top quality experts in all SAP modules, and we're ready to help and assist with our knowledge in SAP. We offer an online platform, SAP optimization assessment, material ledger reports, S/4HANA transitional roadmaps, and cost transparency reports. For more information, you can visit us at ERPfixers.com. Next slide, please. Again, presenting with us today, Gary Cokins. Thank you so much for joining us again. We appreciate you taking the time to speak with us. Gary has a BS in Industrial Engineering and Operations Research. He also has an MBA in Finance and Accounting, and he has previous associations with FMC Corporation, and he was a consultant with Deloitte, KPMG, Electronic Data Systems, and SAS. Next slide, please. Carlos Polito. Thank you, Carlos, so much for joining us today. We haven't had you presenting, but nonetheless, we're glad you're here. Carlos has a BS in Business Administration, as well as an MBA at the University of Notre Dame. He has been a business consultant for 27 years, and during the first 7 years of his career, he worked for Arthur Andersen's Business Consulting Division, where he completed projects related to performance management and profitability improvement for organizations in different industries. He is currently a part of BinTech. It is a management consulting firm where he continues to provide the same management consulting services. He has led more than 65 process and profitability improvement projects, and he helps organizations maximize performance and improve efficiency. Carlos also has extensive experience with all types of costing and profitability methodologies, from internal collections, input for external prices, capacity planning, scenarios, simulations, and process improvement. Next slide, please. Okay, Gary, I'm going to go ahead and hand it off to you, and we will see you later.
Well, thanks, Jess, and thanks for inviting me, and say hello to Paul Ovagel. I met Paul over, 8 or 9 years ago at one of the SAP conferences, John Jordan in San Diego. I've spoke at about 8 SAP conferences so far. Just to add a little bit more to your bio of me, I am 73 years old, but I feel like I'm 43. I did retire from SAS, the large analytics software vendor, who I was with 16 years ago. And 8 years ago, I founded my little single shingle consulting firm. Carlos and I have been for 7 years implementing for clients ABC systems, strategy map, balance scorecard. I'll talk about those a little bit later. So let's get going. And this is about a 75-minute presentation squeezed into 60. So I'm going to talk really fast. Also, feel free to invite Carlos and I in LinkedIn. And you can also send a direct email to us if you want to bypass the chat. And you saw my email address at the beginning, and you'll see it at the very end, and Carlos as well. So who will benefit from this presentation? Professionals who have previously struggled at promoting financial planning and analysis, enterprise performance management, EPM, and integrating business analytics into their decision support systems. Professionals who intend to champion any or all EPM and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation that although it's nice for senior executives to sponsor innovation and new ideas, often they're preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart or more who kind of have passion, fire in the belly, and they ask themselves, how long do I want my organization to continue to perpetuate using stale and arcane and out-of-date methods? And they're the ones that'll do a proof of concept or a pilot or a technique. I'll talk about rapid prototyping to prove to their coworkers, this is the way to go. So if you're 3 levels down the org chart, that's fine. And if you're a consultant, think about how this would apply to your clients. So the agenda is I'm first going to clarify the confusion and lack of consensus. What is enterprise performance management? Briefly kind of define what's business analytics. Then I'm going to describe for about 3 minutes what are pressures that have caused interest in enterprise performance management. Carlos is going to talk a little bit about how SAP is involved in the support. Then for about 45 minutes, I'm going to do a deep dive into several of the enterprise performance management methods, and I'll conclude with how it all fits together as an integrated piece. So I mentioned there is confusion and lack of consensus about EPM. Is it human resources? If you just Google the term performance management, the majority of the hits will be the personnel and HR function, employee appraisals. It's much broader than that. Is it scorecards, dashboards, KPIs, and measures, to align the employees with the strategy of the executives? Yes, but that's is it process, productivity, and quality improvement? Yes, but that's also a subset. That's business process management, lean management, Six Sigma, and the like. Or is it all the above and even more? And it is. And the good news is this. Enterprise performance management is not really something new that people have to learn, but it's about existing methods that many of you have already been reading about or attending seminars and the like. And I'll describe these methods in a while. The issue is when organizations do implement them, they implement them in isolation of each other. So you've got like supply chain people in one part of the building, you got analytics people in another part of the building, you got profitability analysis, another part of the building, budgeting, another part of the building. You get a lot more power and synergy when you seamlessly integrate all of these methods like gears in a machine, and even more power when you spice them with analytics of all flavors, regression, relation, and the like. So since you will get these slides, there is the definition that I just described. It's really about achieving the strategy of the executives and making better decisions. So briefly, what's the issue with analytics? Well, I could give you a definition from Wikipedia, but my suggestion is I'll skip that. Just work backwards with the end in mind, knowing a problem or opportunity that analytics can basically address. So regardless how analytics could be defined, there should be no argument to its purpose. Better decisions, better actions. Analytics goals should be to gain insights and foresight, solve problems to make better and quicker decisions with more accurate and fact-based data, and to take actions. And I kind of lied there. I said I wouldn't give you a definition. That paragraph is not too bad. So here's the sort of the spectrum continuum of analytics. We start at the left, which is looking through the rear view mirror, descriptive, pie charts, histograms. Then we move to diagnostics, see the black dot, that's kind of an outlier, When we go into the windshield, the future view, we have predictive analytics. And you may have known in my bio there, I did co-author a book, Predictive Analytics, 8 or 10 years ago. At that point, I said, well, that's Mount Everest. This is high can you go? And then prescriptive analytics kind of stuck into the scene, but that's good because prescriptive is about optimization. Now, what's caused interest? I'm going to rapidly go through these 8 causes, and then I'm going to drill down into a few of them. The first one is executive frustration with strategy failure. Most executives are quite good at formulating strategy. Their frustration is failure to successfully implement it. And there's a fair amount of empirical evidence. There's a Chicago-based consulting executive recruiting firm. And incidentally, I am from Chicago. Go Cubs, go Bears, go White Sox, although I do live in Raleigh, North Carolina for the last 20 years. But this consulting firm monitors the involuntary turnover of CEOs in North America. It's increasing every year. And I believe what it is post-Enron, board of directors take their job of governance far more seriously. So if the CEO is not accomplishing the strategy, they're gone. A good case study would be Carly Fiorini at Hewlett Packard. They gave her a few years. She didn't do it. They canned her. Number 2, increased accountability. Today, there is no place to hide. Managers and employees will be monitored. They will be measured. It doesn't necessarily mean their job's at risk, but it could adversely impact their salary increases and job promotions. 3, more rapid decision-making. Unlike a few years ago when you could test and learn today and have meetings in conference rooms, today people will be on the phone, go or no go, yes or no. They need to make decisions in near real time. 4, mistrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the management accounting system. Why? Because of those overhead cost allocations. We'll get to that and talk about activity-based costing. Then 5, poor customer value management. The reality is customers are the source of value wealth creation for shareholders and owners. We need to connect customers to shareholders and owners. Problem is, and we'll get to that, most CFOs and accountants are not measuring customer profitability. They're stopping partway in the income statement with just product and service line gross profit margin analysis. 6, contentious budgeting, poor resource capacity planning. This may surprise you. I think the annual budgeting process is so broken. It's such a disaster. My recommendation is stop budgeting. There, I probably caught your attention. But that begs the question, what was the purpose of a budget in the first place? And can we replace it with alternative methods? I'll describe how performance management can lead to that. 7, dysfunctional supply chain management. Now, this may not apply to all of you. Those of you that are in retail and the B2C, business to consumer, it doesn't apply. But those that are you in the B2B with trading partners, here's the issue. Most customers view their supplier as the enemy. It's an adversarial relationship. They pound on them and try to negotiate lower prices. If they put a supplier out of business, so what? We can always get another supplier. That's got to stop. It needs to be a marriage. Trading partners need to basically collaborate to find mutually beneficial projects and processes that can improve efficiency on both of their sides. And finally, 8, unfulfilled return on investment from large IT systems, like SAP or CRM systems or ERP systems, lack of integration. And the issue there is if you ask a CIO, how well do you believe the return on investment, now that you just spent a couple of years implementing this ERP system, how well do you believe the ROI met or exceeded what the salesperson sold you on a couple of years ago? Many of them will be hard pressed. Gee, we put in a lot of time and effort. I'm not sure we've got the ROI. That does not mean you don't implement the ERP. Of course you have to implement it. But they provide a lot of data, but you want to convert the data into information. And the enterprise performance management methods does that. And so the ROI actually comes from the EPM methods, like growing seeds from the ground. So I'm going to let Carlos spend a little time talking about how SAP supports EPM methods. Take over, Carlos.
Thanks, Gary. And just like you said, some companies drown in data but lack meaningful information that sets the stage for impactful decision-making that maximizes performance and profitability, right? So SAP has a solution called profitability and performance management. It's very robust. So with this profitability solution, users can build detailed models and they can convert data into meaningful information, right? So that they can do advanced modeling, they can do amplified insights, and they can activate steering by looking at all the details related to the profitability and the cost of the business so that they can improve their performance. So by building these models, pretty much the user can manage millions of records in just a matter of seconds or minutes, and they can provide all the meaningful information for C-level executives or managers throughout the business, and so that they can pretty much take any non-profitable customer or product and then make decisions around that so that they can improve their performance, right? So for advanced modeling, they can have access to advanced capabilities for creating business-centric profitability and process use case models. And then for amplified insights, pretty much a user can amplify current intelligence with complementary analysis for deeper and richer insights. And then, with the activated steering, they can actually visualize all the value flow of the cost throughout the processes and then to the cost objects, so that they can have kind of like a drill down effect of the whole business. So this is how SAP can provide or support the EPM or enterprise performance management by the use of profitability and performance management or SAP PAPM.
And Carlos, I like the analogy of steering. I always like to use an automobile analogy, which is direction, traction, and speed. You want all three. So, and incidentally, I have CPM up in the title. Corporate performance management and enterprise performance management, they're synonymous. People call them the same thing, and they are the same thing. So now let's do a dive into, I think, 3 or 4 of the 9 forces. In fact, I'm going to do these 4 that I went through briefly at the beginning. Let's start with the strategy failure. What I said is failure by executives to execute their well-formulated strategy. This is where the strategy map and the balance scorecard comes in. Now, you notice I've got the strategy map arrow going into the balance scorecard. That's because the balance scorecard is actually a feedback mechanism. I ask a lot of organizations, you have a balance scorecard? Yes. Do you have a strategy map? No. This may surprise you. I believe the strategy map is 10 times more important than the balance scorecard. And I'll show you an example in the next slide. But above that is something arguably more important. That's the vision and mission statement. That must come from the executive team. That's their job. They need to answer the question, where do we want to go? But what the strategy map and the balance scorecard answers is a different question. How will we get there? What are the projects, the initiatives to accomplish the various strategic objectives in the strategy map? What core processes must we get good at? So the strategy map and its balance scorecard are mechanical. They're like those gears that I mentioned in the analogy in the EPM framework. They help realize that vision and mission of the executive team. Now, real quickly, here's an example, fictitious example of the Kaplan and Nord, Professor Robert Kaplan and Dr. David Nord. They created the strategy map and balance scorecard. One of the reasons they created it was because executives were overreacting to financial results reported at the end of the period. They said, you need to shift your attention to non-financial metrics collected during and reported during the period and react to them. The other reason is they did it is because most employees and managers don't understand the strategy of the executives. Imagine if I went into your organization and randomly interviewed 15 employees in the hallway and said, quick, can you articulate your executive team strategy? How many of them could do it well? Maybe none. Well, if managers and employees don't understand the executive team strategy, then how do we expect them to understand what they do each day, each week contributes to the strategy? So what Kaplan and Norton created was these 4 perspectives that have cause and effect relationships from bottom to top. Learning and growth and innovation at the bottom, that if you're accomplishing those objectives, they'll contribute to the internal process improvement. If you're accomplishing those, they'll contribute to the customer retention, loyalty, satisfaction. Accomplishing all of those, you'll then get to the financial results. So basically, it's a map. All of those arrows, those are measures, KPIs. You get what you measure. You can't measure it, you can't manage it. If you can't manage it, you can't improve it. So to sort of summarize from the bottom to the top, a learning environment will stimulate process excellence. That'll lead to customer intimacy, retention, loyalty, and that'll create the financial value. The way to think about scorecards is imagine if every employee, every single day, could answer this one question: how am I doing on what is important? How am I doing on what is important? Well, the first half of the question is actually easily answered if they've got the scorecard. They turn on their computer in the morning, they see is the dial favorable or unfavorable to the target. And I kind of left that out. The executives do need to set targets on the KPIs. It's kind of like the mule and the donkey with the carrot. They've got to create the carrot. The real problem is the second half of the question on what is important. What are the KPIs to be defined? Strategy map and balance scorecard provide the answer. The overriding purpose of a strategy map and balance scorecard system is to make mission and strategy everyone's job. It's almost like making owners in the employees and managers. Let's move on to the next one. Mistrust of the managerial accounting system and its flawed cost allocations, misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And notice I use standard service lines because many of you are from service organizations. In fact, I recently heard that in the North America, only 8 out of every 100 jobs make tangible products. The other 92 delivering services, banks, insurance companies, government, travel agencies, and but all the principles that I'm describing in enterprise performance will apply whether you're a service organization or a manufacturer distributor. So to solve this, we got to basically use activity-based costing. And I know many of you say, oh, ABC, didn't it fail? Doesn't work. The problem there is in the past, the models were way too large, way too complex. They had thousands of activities. No one could understand them. They couldn't be maintained. We'll talk about a quick way to implement ABC in 3 weeks. But first, I need to explain what is ABC. So here's a simple way. Imagine you go to a restaurant with 3 other friends. You order a little salad, the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines also feel when the accountants take this large amount of indirect expense, commonly called overhead, and it's substantial, and they allocate it to products and services like spreading butter across bread using cost factors like number of labor hours or number of units produced or number of sales, number of employees, head count, square meters, square feet. None of those factors reflect the unique consumption that the diverse products and services consume of the end-to-end business processes and the work activities that belong to the processes. So if you were to decompose the indirect into multiple cost pools and trace and assign them with a cause and effect relationship, you will discover that compared to that butter spreading, in reality, some of the products and services are way overcosted and the others must be undercosted because it's a zero-sum error game. Oh yeah, okay, the allocation method is okay for the auditors, for external statutory reporting, for the SEC and the like, because it reconciles to the penny or the euro or whatever your currency, but it's wrong in the parts. So the simple explanation of ABC, it's as if the waiter or waitress brings 4 individual checks. You only pay for what you consumed. Now, the reason there's interest in ABC over the last, almost 50 years has to do with this diagram. It has the 3 universal components of any organization's expense and cost structure. The direct recurring labor, notice I use recurring, that's for the service people. It's the employees doing repeatable work, direct material, and then the indirect overhead at the above. And notice over time, the indirect is displacing the direct. And when you ask people why, They say, well, automation, robots, computers, that's secondary. The main reason for this displacement is over time, all organizations have had an increased proliferation, for example, of products or services for manufacturers, more colors, more sizes, more ranges, banks, more type of depository accounts, loans, insurance companies, types of policies. The point is this: whenever you increase the diversity and complexity and diversity and variation of the outputs, it just creates complexity. And the complexity causes the need for more and more indirect expense. So 50 years ago, when it was homogeneous products, just one, not much diversity, all right, a little bit of error from spreading the butter, but most of the expenses were direct. That's not the case today at the right side. So we need a much better way to trace and assign it. So the way ABC works is, first we start with the left diagram. Everybody, in fact, that's where the problem begins. Everybody recognizes the traditional responsibility cost center statement, salary, equipment, travel, and so forth. But when you ask managers who get that kind of report, how much insight do you get about the cost that you can influence and control? Their answer is not much. Notice at the bottom, I say, when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. ABC makes them smarter. Now look at the middle diagram. We've converted the same 914,500 into the language of work: key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then we reassign each of the activity costs, the product, services, or customers, just like the waiter or waitress in the restaurant, basically with the driver. It's going to be far more accurate. You'll see why in a second. Now, it isn't quite as simple as the previous slide. I rotated it 90 degrees on the left. It isn't, you take your resources from the ledger, you put them in some activity pools, and you create objects. The diagram on the right is far more accurate because you've got support departments that support other support departments that ultimately support the frontline departments that interact with customers or make products. So it needs to be a multiple stage cost assignment network. Now, I want to warn you, the slides will be complex, but I'm then going to give you a link to a 30-page statement of management accounting I authored, so at your leisure, you can read it more slowly. This is a pretty good description of any organization's expense and cost structure. You've got the resource expenses at the top from the ledger. Business sustaining. Each of those arrows, I'm getting an internet unstable. I hope I'm okay. Each of those arrows, think of them as thin straws or wide pipes, where the diameter reflects the amount of money flowing through. That's why it reconciles from the bottom to the top. In fact, the total costs at the top will exactly equal the two boxes at the bottom right, the customers and the business sustaining. The message here is costing is modeling. Costing is not T accounts and journal entries. Now you'll notice that a couple of the boxes in the work activities are not going to the products, going straight to the customers. Those would be selling expenses, marketing expenses, and we'll get to that in a few minutes. That's the cost to serve. That's so we can actually get a customer profitability report. Now I mentioned I went through that quickly. When you get these slides, if you click on the link at the bottom, it's a 30-page paper that I authored for the Institute of Management Accounting. I'm a 30-year member of the IMA. In fact, for 3 years after I retired from SAS, I was their executive in residence. What matters, though, is what do you see after you've done ABC? And this is a diagram when you're looking at real data that is often referred to as the humpback whale curve. Notice it looks like a humpback whale. The vertical axis is the net revenues minus the properly calculated and traced cost, ABC costs. The horizontal axis is the cumulative buildup of the profit, but it is rank ordered from the most profitable product or service, second most profitable, and so on and so forth. The very last data point at the right will exactly reconcile with the P&L. So in this real company, they had 30 in revenues, 20 in expenses, and net out at 2. The last data point is 2. There's always organization shock to the managers and executives when they see this graph. because it says to them in this one, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost $6 million on the remainder to net out at 2. They can't believe it because their belief system is it's that blue line, because all of that butter spreading of the overhead was basically crushing and suppressing, any of the accuracy. What ABC was detecting all that diversity and variation in which activities go where and where to produce the top line. So the top line is the truth. The bottom line is basically false, the blue line. And if you remember anything from this entire presentation, remember this. In the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss or the boss of the boss. So to the degree that they're making decisions on gut feel or intuition, like the blue line, the organization is at risk. Now, some of you will be saying, golly, Gary, you're starting to persuade me. We maybe should be doing ABC at our place, but it'd be a mudslide of data. There'd be 3,000 activities. Every employee would have to fill out a timesheet. Employees hate timesheets. It'd be monstrous. IT would have to extract drivers. Those are all misconceptions. Fortunately, about 10 years ago, I came up with the technique to implement ABC in 3 weeks. So this is something Carlos and I do. Model 0 at the end is a 1-day exercise. We just get 5 or 6 cross-functional employees in a room. We build a high-level model. It's not intended for any accuracy, very quickly, kind of cost pools, product families, and so forth. And then the next day, the morning, we bring in the executives and managers that work with them. It's like a debriefing, and the light bulbs go on with all the people in the room. Oh, that's how we get rid of that butter spreading. Oh, that's how we can actually see profit margin analysis. Oh, that's how we could do benchmarking with apples, not apples and Oreos. A couple of iterations. Carlos usually spends about another 2 weeks, maybe does 2-3 iterations. Boom, the triangle, a permanent, repeatable production system. Make your mistakes early and often, not later when the system is hard to change. All right, let's move on to the 5th of the 8 forces, the shift from being product-centric to customer-centric. The value of a company is a function of the value that comes from its customers. The only value a company will ever create is the value that comes from its customers, the current ones, and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, and serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a couple of problems here. Most CFOs are not measuring customer profitability. They're stopping halfway down. Basically, the shaded box, the entire rectangle, is all the expenses for a period, let's say January or last quarter. The shaded box is all that the accountants are calculating for. But what about distribution, selling, marketing, general accounting, and administration? We want to include those. So, the problem is you got to go below the product gross profit margin line to include selling expenses, distribution expenses, marketing expenses, cost to serve of the customers. Then we've got this other problem, angel customers and demon customers. What do I mean by that? Demon customers, high maintenance. They're always changing delivery schedule. They're never buying standard, always special, always calling help desk, always returning goods. Angel customers, you love them. They only buy standard. They never change delivery schedule. They never call help desk. They never return goods. If those 2 types of customers at the extreme bought the same volume, same mix, same price, they're not equally profitable because the demanding ones are causing a lot more, if you will, cost on your end. But what really caught my attention about this book, which incidentally is a marketing book from some Columbia University faculty, there's not much talk about management accounting in it. What caught my attention was the subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. And that's what I mentioned earlier, that customers are the source of value creation for shareholders and owners. So with ABC, you can actually create a profit and loss statement for each customer, and the layers of contribution margin are layered like an onion skin. And in this fictitious example, you can see that there was a 30%, this is the right column, a 30% aggregate composite average gross profit margin. But between the 30 and the 8, 22 more points of profit are eroded, nothing to do with making the product, but all with distribution, selling, and marketing. And if you calculate those two broad swath, product related and channel customer related, for every customer, you can create a diagram like this, where each customer is a circle intersection in the grid. The vertical axis is the product gross profit mix. The horizontal axis is that cost to serve, angels to the left, devils to the right. And now things become obvious. The most unprofitable customers are in the bottom right because they're difficult to serve, demanding, and they're buying low margin mix from you. The most profitable ones are in the upper left because they're buying high margin profit mix from you, and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left. And that would be a whole other seminar. Maybe Paul will go have me do that. But one example to move the dots would be fee-based unbundling. The bank's been doing that with depository accounts for a long time. Look at the airlines. They charge you unbundling fees for baggage, or if you want to move from a middle seat to an aisle seat. All right, let's move on to budgeting. Remember I said the budgeting process is broken. The budget is typically a fiscal exercise by the accountants that has two problems. It's disconnected from the executive team strategy, and it's not based on future driver volumes. It's not volume sensitive. Now, here's a quick quiz. How many of these boxes would you check for your organization? Your annual budgeting process is invasive and time-consuming with few benefits. Takes 6 months from beginning to end. Requires 2 or more executive tweaks at the end. When you give it to executives, they don't like it, keep changing the numbers. It's out of date in a couple of months after you publish it anyway. It starves the departments with truly valid needs. So maybe next year, a certain department's going to need more headcount because there's been a shift the way you do business. You didn't give them. Caves into the loudest voice and political muscle. That's those veteran sandbaggers, guys like me, in their 60s, bald. They've been around. They know how to play the game. It incorporates last year's inefficiencies into this year's budget. The process was inefficient last year. We replicated. The last one is the one that bothers me the most. Because when a manager is a few months, let's say 3 months from the end of the fiscal period, and they appear they're not on track to spend all of the budget that was approved for them, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that next year's budget is going to be pegged to how much they spent this year. We call it use it or lose it spending. The problem is it's kind of like done on a spreadsheet. In fact, here is a spreadsheet. And you know how typically most organizations do the budgeting is they give each manager a spreadsheet like this for their cost center, but they fill it out all the way January to December, okay? And the detailed items of ledger accounts, including paper clips and rubber bands. And then someone in the accounting department consolidates all of them. You bring in the revenue forecast from the sales, you give it the profit to the executives. They don't like it. So change some numbers. All right, so everybody gets their spreadsheets back. They lower some of their expenses, consolidate it back to the executives. They say that's a little bit better, but not good enough. Up, down, up, down, up, down, up, down. Come on. We almost want to ask the executives, what number did you want in the first place? So we don't have to do all this spreadsheet stuff. But that basically would be their aspirations. We want to know what can really happen. So what we can do is we can integrate the performance management methods. And here's a way to think about it. The amount of spending, which is to the right, is a result of 2 river streams. The upper river stream is the recurring repeatable expenses. That will be demand driven. Okay. The bottom river stream is going to be the non-recurring, non-repeatable expenses. Those will come from projects. And I'll describe that in just a few minutes. Well, let's start at the top. For the recurring expenses, I'm going to do a little bit of industrial engineering 101 here. I think it was my second semester freshman year at Cornell. The formula is volume mix times unit level consumption rates equals capacity required. Well, those unit level consumption rates, that comes from the ABC system. The ABC system is great for strategic profit margin analysis, but you get a bonus. You also get unit level consumption rates, cost per material move, cost per blood test in a hospital, whatever is the activity, they're all going to have a unit cost. We multiply volume and mix, and we get the number of employees, salary, and wages. In the bottom, there are three types of projects. Strategy projects. Remember in number one cause I mentioned about 30 minutes ago, you want to identify the projects and initiatives to accomplish the objectives in the strategy map. So, well, we need to fund them. Now we've connected strategy, if you will, to the budget. We've also got risk management. We've got potential risk events. We want to fund them. And then we've got good old capital budgeting. We're all familiar with that. So just sort of go back to what I just said. For the operational expenses, we basically calculate the ABC model backwards. We forecast volume and mix. Actually, let me show you. For the historical view, the expenses are known. We calculate the cost objects. We get the unit level consumption rates. Now for the predictive view, we forecast from bottom to top, and there's that equation, the industrial 101 equation. Demand, volume, and mix times unit level consumption rates equals capacity required. Risk management, the risk management community, they use this grid. Each of those circles is a potential risk event. The diameter is how much money would be required to mitigate it. The vertical axis is the severity and impact if a risk event was to occur. The horizontal axis is the probability. So when we're in the upper right corner, it's highly probable and it's going to be painful. Budget for it. Of course, you can't budget for everything. It'll eat too much into your profits. Now I'm going to decompose the two river streams. The shaded boxes are the upper river stream, and the ones to the left are the lower river stream. Put your attention on the bottom right shaded box. It says derived budget and rolling financial forecast. Notice from the top, there's the operational budget. Remember, we've got the volume and mix times the unit level consumption rates equals capacity required, head count, pounds, kilograms. We monetize it, euros, dollars. That's good. From the left, there's the capital budget, the strategy budget, and the risk budget. Now, what's nice about this diagram is the only independent variable is the forecast of the drivers. So if we refresh the forecast at quarterly, maybe even monthly intervals, we're going to be able to produce a pro forma income statement and balance sheet. And many of you who are accountants know what's the next step with that? Net cash flow. And that's what board of directors have been looking for during COVID, because they were wondering, God, is the company I've got responsibility going to go bankrupt? What's going to be the deal here? Now, you do need to think like an engineer, though, when you do the predictive view. The historical view, all right, you just basically assign the expenses. But for the predictive view, you've got to classify the behavior of the resource capacity as sunk, unused, fixed, step fixed, or variable. And you'll notice in this diagram that as the planning horizon goes out, more and more costs that were fixed become variable. Examples, we can replace full-time employees with contractors or temporaries. We could basically, instead of purchase assets, we could lease them, which makes them variable. So you really need to basically use some almost industrial engineering thinking when you're going to be doing the predictive view. And it isn't just the rolling financial forecast. What if scenarios, make versus buy decisions, and the like all require what are called marginal incremental expense analysis. You read about it in the textbook, but you're probably not doing it in the real world. So let's now basically go back to Carlos, and then I'll wrap up the presentation.
Thanks, Gary. So talking again about SAP PAPM, users can easily build and manage multiple business-centric models. So SAP PAPM is a very powerful yet easy to use, user-owned, controlled, and managed business model. So pretty much SAP PAPM sits on top of HANA. So for those of you SAP users who know HANA, HANA, it's a very powerful database. So that's how PAPM can manage millions, if not billions of records in just a matter of minutes. So you can build very complex models very quickly and be able to provide detailed information so that managers can make informed decisions. So it's a business user-oriented, intuitive graphical drag and drop interface. It uses pretty much just a handful of functions, and you can go ahead and drag and drop all the different functions where you can pretty much enter all your data or import the data from your ERP system. You can build all the different steps or functions so that you can model or assign all the costs throughout the different steps of the methodology, and then be able to provide different graphs or charts so that users can visualize in a friendly way, all the different results. And then you can define a multi-step cost allocations without any coding, pretty much, right? It's just, like I said, it's just a drag and drop and just giving the system very simple instructions. And then your users can build sophisticated models of complex business processes and industry use cases attuned to the unique needs of the business. And then also best practice pre-built package content aids rapid model development and time to value. So as you can see on the right-hand side, there's a wheel that has many different use cases. For example, tax-related models, process modeling, profitability, cost modeling, etc. So we typically, as you may recall from what Gary mentioned about model 0, 1, 2, 3, sometimes we use these pre-built models, kind of like a model 0 or model 1, and then we tweak those models so that we can adapt into the business, and then we can continue to build on top of that model. So you're not starting from 0, you're not starting from scratch, you're starting from a pre-built model that you can use and enhance so that you can pretty much have a very detailed profitability model to satisfy the enterprise's needs.
And when Carlos and I have done this rapid prototyping, and he can actually complete the ABC system, permanent repeatable production system, in 3 weeks, many of you are probably saying, how can that possibly be done? Well, you got to understand there's a difference between external financial statutory reporting and internal management accounting reporting. When we're basically building a profitability, basically it's a model that turns into a system, and it doesn't have to be perfect. We have a phrase, it's better to be approximately correct than precisely inaccurate. Yes, for the external statutory reporting, of course, you get those numbers wrong, you go to jail. But if you get the management accounting numbers wrong, you don't go to jail, you know? And so what we've discovered, though, is most of the accuracy comes from the multi-stage cost assignment network and the relationships. So if you can imagine a graph where the vertical axis is the accuracy of what you want to know, let's say product cost, and the horizontal axis is the administrative effort to collect the data, calculate the data, report the data left to right, you get a asymptotic curve. In other words, the line goes up real quickly, steep, turns at the elbow, and then to the right. Stop at the elbow. You know, you get diminishing returns on extra accuracy for the extra level of effort of work. So, you know, if you've got typical ABC models have 60 to 70 activities, you're going to get 98% accuracy. To go from 80 activities to 800, you pick up an extra percent. You got to think like an engineer. So let me show you how it all fits together. This is my diagram. The large blue box, organizational resources, think of that as your assets and your employees. And I'm going to explain this diagram in a couple more. I'll decompose it in a second. We've got the customer loyalty at the top. Notice I've got an arrow going way to the right and to the bottom into the shareholders. That's where we connect customers to shareholders. Remember, customer value creation to shareholders. Think of this diagram like your heart and a circulatory system. Let me take you a little deeper into it. We start in the customer satisfaction box. Notice to the left, strategy and mission. The executives will formulate the strategy based typically on customer needs. Then down, they will communicate strategy, remember, to employees and managers in a way that they can understand it, a strategy map. And there's where we can define the KPIs. Now, we're basically reporting the KPIs daily, weekly, monthly, if you will. They basically are the feedback mechanism to the organization. Remember, then every employee can answer, how am I doing with what's important? Also, I'm going to go a little offline here. A lot of people have way too many KPIs. I ask people, how many KPIs you got? Oh, you know, we got 300. Oh, 300, that's great. How can they all be a K? What you want to do at a high level is just have 2 or 3 KPIs per strategic objective. That'll keep you to just 30 or 40. That's why they're key, okay? Now you can basically cascade them down into what I call OPIs, operational performance indicators. KPIs, you only monitor maybe monthly, maybe weekly. OPIs, that may be daily, even hourly. The definition of a KPI is this: monitoring the progress towards accomplishing the strategic objective. Monitoring the progress towards accomplishing the strategic objectives. KPIs are for strategy management. OPIs are for operational improvement. Okay. Now let's go from the blue box up to the customer targeting. Which type of customer is most attractive to retain, to grow, to win back and acquire? Which types are not? How much do we optimally spend? The CRM stands for Customer Relationship Management System. Now look at the counterclockwise loop there. That's kind of the whole ERP, if you will, or process lean management area. Take the customer order, complete the order, accept the hospital patient, heal the patient. That's the better, faster, cheaper loop. Collectively, it's better, faster, cheaper, smarter, using the strategy map, safer, using risk management. So think of these things as flowing. In fact, if you can see, there's little white dots. And because I don't have the technology for this presentation, just imagine that those dots are all flowing. They're flowing every minute, hour, day, week, month, just like the blood circulating your system. But what this diagram is showing is, look, to the degree that I may have excess unused capacity, inefficient processes, poor selection of customers, the money doesn't go to the shareholders, it leaks into the sewer. So the optimization is to basically not have any of these arrows be restricted. I call it arteriosclerosis of the EPM. You want it all to flow. Now, a frustration for me. What is taking so long for organizations to implement these EPM methods? Why has the adoption rate for analytics-based EPMs methods been so slow? Well, there are three broad barriers. The first one is IT related. Part of it is just dirty data. It's got dirty source data, impure data, but the IT function has a tool called extraction, transform, and load, ETL, that can fix that. Also, larger companies may have different hardware vendors. We got HP, we got IBM, we got Dell. IT can fix that. The second barrier is the perception barrier of excess complexity and affordability. They all think, oh, it'll take 6 months. It's going to be huge. The benefits aren't going to exceed the costs aren't going to exceed the benefits and all of that. I think Carlos and I already described for a few minutes, with rapid prototyping and iterative modeling, you can have an ABC system in 3 weeks. I didn't talk about balanced scorecard strategy map. If you want to contact me individually, I have a technique to implement a strategy map and balanced scorecard in 2 days, 2 days. But the real issue, the real barrier has got nothing to do with technology, with software, with systems. It's about people. It's organizational behavior, and it starts with resistance to change. People like the status quo. Only babies like change, diapers. Fear of knowing the truth, fear of others knowing the truth. Oh, I don't want that other department to know my cost. Oh, I'm a product manager. I don't want anybody to know my product line is actually less profitable than on our flawed system. Fear of being measured, fear of being held accountable. Weak leadership. There, I said it. Not every executive team's got the highest IQ. So if you want to be successful implementing these methods, you need some behavioral change management skills. But how many of you have degrees in the university from sociology or psychology? None. You're all Newtonians. I am too. Carlos is too. What are Newtonians? To us, the world's a big machine. Give me the levers, pulleys, dials. We need to have a little bit of Darwinian, like Charles Darwin, sense and respond, if you will. So I like to conclude by the complete vision of performance management. On the left is one of my books. It's actually a fairly popular book that I wrote on EPM. Notice the greasy, grimy gears. If some of the teeth are broken, imagine that. Some of those gears are disengaged. Someone threw sand in there. Put that in your car engine. What would it run a little bit? What would your fuel efficiency be? Pretty low. Now replace it with the right vision, titanium gears, spinning faster revolutions per minute, digitized, lubricated. Now put that and integrated. Put that in your car engine. Now what's your fuel efficiency? Much higher. Now replace fuel efficiency with the metaphor, we're shareholder wealth creation, much higher profits, make the revolutions per minute of the CPM and business analytic gear spin better, faster, cheaper. That's the lean management process stuff. Safer, that's using integrating enterprise risk management. Smarter, using strategy map and balance scorecard. Action steps for you: get educated. Thank you very much. The fact that you're even listening to this webinar, you're getting educated. Get buy-in from managers and executives. Rapid prototyping, start small, think big. Think of a rapid prototype as a pilot on steroids. And improve incentives. I don't have expertise in motivational theory and salaries and bonuses, but it's important. When you get these slides, the links underneath it have articles that I've written that you could actually share with some of your colleagues, and you can also share these slides. Of course, they don't get to hear the visual. Your success depends on how well and how fast the right information and intelligence gets to the right people. And I want to talk briefly about the analytics. You know, when I was going through them, I know some of you were going, oh, golly, regression, correlation, clustering, association, segmentation. I took those courses in college. I just wanted a passing grade and get the heck out of there. You know, well, sorry, it's here. But the good news is you don't need to go in your basement or attic and get those textbooks out, but you do need skill sets in your organization that do have data science competencies. So there is our websites. There is mine and Carlos's email addresses. Feel free to send us emails with questions. I'm going to get to Jess here in a second. She's going to collect whatever questions came in the chat. And feel free to invite Carlos and I in LinkedIn. So Jess, handing it back to you.
Thank you so much, Gary. Okay, again, due to the essence of time, we're not going to have time for the live Q&A. However, as Gary just mentioned, you can email him or I did collect the questions that were dropped into the chat box. ERPfixers will be posting this on our website next week. For those of you who are registered and attended, you will get a copy of this recording as well as a copy of those questions and answers. So once again, thank you so much, Gary and Carlos. We appreciate you taking the time today. And for those of you who were able to watch the presentation, we thank you as well.
Yes, because we have 1 minute left. Can I just make some closing remarks?
Absolutely, go for it.
Okay, one, when I titled this a mini MBA in 60 minutes, if you really think about, if you go to any curriculum, Stanford University, I went to Northwestern's Kellogg, Harvard Business School, look at their curriculum. We touched on almost all of the curriculum courses in an MBA program. And then let me conclude with this. I believe in the past, the best executives and the best leaders had the best answers. Today, I do not think that's the case. Today, I think the best executives and the best leaders have the best questions. There is too much complexity. There's too much volatility. There's too much uncertainty for them to rely on their gut feel or sixth sense or intuition, or the types of answers they gave in the past that got them promoted to the top. They need to create a culture for analytics, discovery, and investigation, if you will, and tolerance for making mistakes, as long as you learn from mistakes. So I just wanted to conclude that, to me, is what the ideal leader and executive. They're creating that culture to ask questions. The questions then lead to answers. So thank you all again for attending. And again, Jess, say hi to Paul Overgel from Carlos and I, and always fun to basically interact with Paul.
Thank you so much, guys.
Thank you, Jess. Thank you, Gary.